Dhiraj Sachdev joins in from HSBC Asset Management to talk about his take on the markets. Dhiraj, hi, morning. Is this the big top out for the markets that people are talking about? Do you think 9,400 was it, or do you sense that given the kind of earnings recovery and the surprises that we are seeing from individual sectors, there is scope for further more?
Yeah, good morning, Aisha. Thanks for having me. If you ask me, my fear is that the corrections will be very, very short-lived. And let me take a step back to understand and analyze why the market has rallied over the last few months. And this has been largely driven by a host of multiple factors. So be it the state election verdict, or short-lived demonetization impact, or expected improvement in corporate earnings, or the resolution on the part of government, which is a very big challenge for the NPAs of the banks, or even the GST rollout, which is expected to happen in the near term. But I think the most significant driver of this rally has been the shift in asset allocation on the part of retail investors from traditional physical assets like gold or real estate in favor of equities. And I think this rise in equity culture is a very powerful driver of a sustained rally. So I don't think the markets will stop here. My fear is that corrections will happen for sure, but it will be very sharp and short-lived. So people will buy into it. There are a lot of money which is waiting in the sidelines. I am constantly asked questions time and again, when is the correction due? So that means that people are waiting for the corrections. And so corrections become elusive in the near term for them. And even if it happens, I think the money get invited and sucked into the correction. So correction is going to be short-lived. Having said that, if I have to stick my neck out, I think this is a very strong bull market, and I could dare to say that it is probably 2.0 bull market, which is going to be as elongated or even bigger than what we have seen between the periods 2003 to 2007. And as a result of which, we see that the market rally could get sustained. We have all the fundamentals in place at the current point of time. Again, to add a caveat, a little bit of caveat to my bullish tone, some of the companies may have run ahead of time, ahead of economic recovery or ahead of their earnings. And if there is any kind of earnings disappointment, those stocks are getting punished and will get punished. And we are already seeing a reflection of that. The other is also, if similar treatment of correction or punishment will be meted out to mediocre businesses or mediocre companies with substandard business models. Besides, even the IPO listed companies have run into some kind of a frenzy valuations, and one has to be very careful because there is some kind of unjustified inflated scarcity premium associated with IPO listings. So one has to be very careful because the earnings over the next 1 or 2 years at least will not justify this kind of valuations, and if there is any kind of growth disruption in such companies, then these stocks get corrected and get derated fast enough. So again, to reiterate what you have asked, my sense is that corrections will happen, but it will be very short-lived in nature.
One side you're saying that valuations are not all that compelling, earnings recovery is not around the corner. The other side you're making a case that corrections would be short-lived. Do you think markets can continue to ride this liquidity wave? Because Dhiraj, we've seen, and you've seen, and I've seen that when market corrections come, liquidity can reverse. I mean, liquidity is sentiment. If the sentiment gets bad because of a 5-7% fall in large cap and a 10-15% in mid cap stocks, the guys who are right now waiting for correction, they'll be throwing up what they own.
Because you're right, when the sentiment shifts, then the market spares no one, whether it's a good company or bad company, all fall alike. But it will be wrong to say just a liquidity-driven rally. Of course, liquidity chases good fundamentals, and that is what we are witnessing. Let us analyze the situation of 2007 and 2017 now. I mean, 2007, when there was absolute euphoria and the valuations were at 23 times, people were justifying every company. We are seeing some signs in some pockets, but it will be wrong to conclude that the entire market is overvalued. I mean, I personally, when we look at few hundred companies that are listed in the mid and small cap basket, it will be wrong to conclude that the rising tide has lifted valuation of all the companies. There will be, of course, certain companies which will be misappraised or mispriced or not recognized by the market. So I don't think that, broader market, even at 18 times as we speak, financial year 18 earnings, is not all that expensive. There are certain pockets and segments that I highlighted. Some mediocre businesses may have run ahead of time. Some IPO listed companies may have run ahead of time, and there is frenzy out there. So one should be avoiding it and scrape through to find out good companies or sectors.
Dhiraj, so I mean, how is it that you position yourself in the market right now? Tactically, do you profit take from sectors which have been doing well, real estate, selective banks, or for that matter, even metals as such? Because, it seems like when the markets do top out, these are the sectors, the typical high beta names, which are likely to come off faster. And do you now start deploying money into the laggards or not quite? Do you think IT and pharma are an investment case at all right now?
So Aisha, there are multiple questions or multiple sectors that you've asked, and let me just briefly talk about how we are positioned within the mid-cap fund. We don't own real estate or metals because these are largely large-cap companies, at least on the metal side, so we don't own. But our positioning is largely tilted towards non-banking financial services companies or NBFCs within the mid-caps. We think that this sector is poised for probably a sustained growth going forward. And let us decompose the NBFC segment as such. So it includes from commercial vehicle finance to gold mortgage finance to microfinance to stockbroking and wealth management businesses. And I think even housing finance, for example. Now, just take two of these segments within the NBFC pack, be it housing finance or gold mortgage finance. There are stocks which are fairly large size and they are still available at 2 to 2.5 times adjusted book values. So we don't find valuations crazy in these segments. Gold finance, for example, it's a duopoly kind of a market as far as the organized players are concerned and the large players are concerned. And the penetration is still low at about 3 to 4% within the organized gold mortgage finance business. So we believe there is a lot of room to grow. India is a capital starved economy and the credit to GDP ratio is still pretty low. So there's a lot of room for the retail finance products to sustain growth going forward, and it is only growing and increasing with Jan Dhan Yojana scheme. So the NBFC forms a very large position as far as our mid-cap fund is concerned. Besides, we do own other sectors, be it agrochemicals or specialty chemicals. We own cement, we own ideas within the industrial pack. We own print media where the valuations are still relatively attractive. On the question on IT and pharma, I think the consensus opinion is becoming very, very negative. And I think it will be a wrong time to sell out and ignore these sectors completely. Of course, IT, for example, is facing rupee headwind, including pharma. IT also faces uncertainty in the form of US visa cost or US hike in visa pays, H1B employee costs, which can be margin dilutive for most of the IT companies over the medium term. But our sense is that on a historical basis, most of the larger companies are also trading at about 14-15 times multiple, which is at a historical low. And there's exciting prospect. At least the US economy is doing well. If US economy is doing well, that means the verticals like financial services or retail, which are large IT spenders, augurs well for the Indian IT companies. So on balance, we are neutral in the large cap funds within the IT, and we can't be negative now because the world is getting negative. On the pharma side, it's very individual stock specific positions that we have across the funds. Pharma, again, the business models are very, very differentiated. It's a good thing that FDA inspection has reeled these stocks under pressure over the last 2 or 3 years. And we know many companies are taking good remediation measures, deploying people to ensure that they rise up to the US FDA standards. And eventually, I think some of them will, sail through and be on par. So given the fact that generic pipeline is very strong, we already saw large peers like Teva or Mylan talking about that there is a stable pricing scenario on the US generics of late. So I think the US pricing pressure on the generic is also receding. So I think there's a time where some has to take a contrarian view on these two sectors as well.
Where are you booking profits? I mean, we always tend to focus on what fund managers are buying, but when they're buying, they're also selling something.
So, Nikunj, it's very stock specific within the, since the mid cap has bottom up orientation, it is not sector specific. If there are stocks where I feel it's becoming expensive, about 25-30 times multiples, it has run ahead of earnings, there could be disruptions because maybe GST implementation means that there could be volume degrowth for some of these companies, and you may be able to buy it lower at some stage. Then we are trimming those positions in favor of others which are relatively inexpensive, or where the market has misappraised those companies or not even fully fairly valued those companies. So that's a constant exercise. So we have booked some gains in for example, pipe companies or some of the other stock specific companies where the valuations have become probably ahead of its earnings.
A lot of AMCs have stopped accepting money in the small cap funds. They feel that small cap run up is extraordinary. They don't have ideas. So keep it simple, don't take money because they are not comfortable. Are you thinking on those lines?
Because fortunately we are running scarcity and not dearth of ideas, scarcity of funds. So we are not as large size as some of those funds which have stopped accepting money. I think we have plenty of ideas on the table to buy into, and our view is very differentiated.
You've always said that private banks is the way to go, but now if I look at the valuation difference between an SBI and a RBL, or a SBI between Kotak Mahindra Bank, it is at a historic high. Whereas you betting on the retail space by buying into NBFCs, do you think when it comes to economic recovery, one is better off buying wholesale banks now rather than just latching on to those typical retail dominated banks? Because let's be real, Dhiraj, I mean, retail is where all the competition is, retail is where all the fight is, retail is where all the struggle is, and banks are struggling to grow the retail book now. It's evident.
So you're right, Nikunj. I think on the mid-cap side, we have avoided private banks which have become 4 times, 5 times their adjusted book values. And I think they are pricey, they offer little margin of safety. So my focus has shifted towards the NBFCs, which are probably at half the valuations of some of these private banks which have got recently listed. They are gaining market share from PSU banks. They are in niche segments, say for example, whether it's housing finance business or gold mortgage finance business, with competitive advantage compared to a wholesale or a corporate bank. So I think my focus within the mid-cap fund is more towards NBFCs than the pricey private banks that you mentioned.